So, deficiency judgments. What happens to all the lost money? This is probably the most important aspect of a short sale that any borrower should be concerned with. Unfortunately, it is also the most I would say wrongly advised or ill-advised as well by a homeowner's advocate in a short sale transaction, which is either a realtor or attorney. So what does happen to the lost money? How does a bank deal with the losses and whatnot? And let's go ahead and sort of get right into this. So believe it or not, the reason to do a short sale, first of all, as you know, is to rid yourself of the property. However, it is very important to remember that you and you only are the owner of record of that property all the way up into the foreclosure sale date. Therefore, you as a borrower are the only person that can entertain any and all offers on the property. So, believe it or not, this gives you the upper hand when negotiating with a lender. And this is why it is so crucial that any borrower utilize a company or an individual who is truly well versed in this. This is night and day from a traditional transaction. And if your facilitator, your agent, or attorney, whoever you are working with on your short sale, they should know and understand how a bank deals with the loss so that you can therefore get the best end result. So believe it or not, the majority of the times when a borrower is when a short sale is negotiated properly, and in our cases over 90% of the time, the borrower will get a forgiveness of debt on the loan in conjunction with a 1099. Okay, so I'm going to go into the 1099 in a second, but just right off the bat, I do want to know that most borrowers, 90% of the time, are not going to have any sort of liabilities for the following reasons. Now, the next thing is, what is a 1099 form? And a lot of borrowers are like, well, you know what, I don't want to get a 1099. I don't want to pay income tax on that, because let's examine what a 1099 is. So basically, when you're facing foreclosure and or short sale, there are two types of 1099s that are issued. And let's first dispel one of the misbeliefs or one of the myths, I guess, that are out there right now. And that is that, oh yeah, if you go to foreclosure, you're not going to get a 1099. That is absolutely incorrect. If a property goes to foreclosure, the borrower can expect to receive what you call a 1099-A, which is an abandonment of debt. That 1099-A can be a taxable amount to the borrower. If the property goes to short sale, the borrower can expect to receive a 1099-C, which is a cancellation of debt. Either way, technically speaking, what the bank is doing by issuing a 1099 is they're pretty much saying, hey, my loss is your gain. So I paid that borrower that amount of money this year. And this is fine, because most people don't understand that the 1099 in this market under the recent legislature is the best thing that you can get. Now, what is a bank saying when they issue you a 1099? They're pretty much saying, hey, I paid this person that amount of money this year. And from a bank's perspective, the 1099 really acts as a great way for them to write off the loss by paying that borrower this money. Now, for a borrower, it's basically saying, the bank is saying they paid you this money. So, yes, you would have to claim that as income, correct? Yes, prior to 2007, that would be correct. But the reason why you want the 1099 form is because once the bank issues you the 1099, how are they going to still chase the borrower for the deficiency? What I'm going to show you next is to show you how a 1099 rarely is a taxable consequence to a borrower. And receiving a 1099 is almost like your insurance, showing that the bank cannot come after you because they already written the loss and reported such to the IRS. So why do we want a 1099 form? Do I not want to pay taxes on this, or what is my my main goal here? Well, let me go to what we call the Mortgage Forgiveness Debt Relief Act of 2007. This was passed by George Bush on December 20th, 2007, and it was set to expire at the end of 2009. President Obama has reenacted this legislation to take place and remain in effect through the end of 2012. So it is very important that you understand the difference in how these 1099s are handled. And basically what the Mortgage Forgiveness Debt Relief Act says in a nutshell is real simple. It says any borrower who receives a 1099 resulting from a foreclosure and or short sale are completely forgiven from any 1099 liability or debt realized by the IRS. Only if A, it is their primary residence, or B, the borrower is deemed as insolvent. So basically what this act is stating is that as long as you file your taxes correctly, utilizing what you call an IRS Form 982 with your accountant at the end of the tax year, you will not have to pay income tax on the 1099 received. Folks, this is the bailout. Everyone's asking for a bailout on this and that. This is the bailout because borrowers are literally walking away with no financial liability as long as you settle the debts. In the previous video, you see why that is so important to understand. So, why is this it's such a great idea? And the next question is, well, it's not my primary residence. So what should I do in that case? Well, as long as you can claim insolvency, if you do not fit the requirements of it being your primary residence, or if you took out another loan, you took out a second loan after the purchase, there are some strict requirements that you do need to look further in with your CPA. But basically, as long as a borrower can claim insolvency, they will also be forgiven from any 1099 liabilities. And basically, the definition of insolvency is any time a borrower has more debt or liabilities than actual assets. So basically, they're underwater in terms of their net worth. Now, most borrowers in a short sale situation are going to fit this category. And it's been my personal experience that I've only seen probably less than 1% to 2% of borrowers not qualify for the insolvency provision. And it's very, very important to determine. Now, I'm not a CPA and I'm not giving you CPA advice, but this is the questions you need to be asking your CPA. And these are the questions that your realtor and or advocate in your short sale should be pointing out to you. So let's go back to two other things I wanted to mention on the deficiency judgment section. And you'll see right here on their bullet point 3, promissory note. So promissory note is, let's give you an example. Let's say a lender is approving a short sale and they want the borrower to sign a promissory note for $20,000 with 0% interest payable over 40 years. Let's say it's $81 a month. Now again, if you have a true short sale professional in your corner that would understand this, they're going to know how to negotiate with the lenders on getting rid of this promissory note by possibly offering what you call a cash contribution, which is the last bullet point. So in that negotiation, I may say, well, yeah, the borrower doesn't want to sign a promissory note. They may just want to file bankruptcy. But the buyer, the borrower, or this borrower themselves may have $2,000 to $5,000 to bring to closing as a cash contribution. Will that get them out of the promissory note? Again, those are things that are all about handling and working with the right professionals. People who understand these concepts and understanding how a bank's losses look from their point of view. I mean, how can you properly negotiate with a lender without knowing how a lender thinks? By knowing how they think and their alternatives, you end up having the best result. So again, it's super, super important to know the difference. And again, let me just point out that the deficiency amount is the amount of unpaid principal balance and or interest accrued. So I hope this brought you some more clarity on the issue. This is the truth. This is what we see daily. So I hope this was very beneficial for you. So I hope you enjoyed the information and see you in the next video. Thanks.